Good morning, class. Welcome to Arjun English School. Today in Standard 11, I am going to start a chapter Ledger Posting, chapter number 9. In earlier session, we have completed chapter number 8, that is general. Now, in today's topic, it is related to ledger and its posting. So, ledger posting is basically on the basis of journal entry as well as subsidiary books as well as cash book. So we have already studied journal entry, cash book, and subsidiary books. On this basis, we have to prepare a further step that is called ledger posting. Means if you don't know about journal entry, subsidiary books, and cash book, then ledger posting is becomes irrelevant for us. So first of all, you have to understand very carefully about the ledger and its posting. Okay. This chapter in examination can be asked for 6 to 8 marks based on the journal number of journal entries. So here, first of all, I am going to explain the meaning of ledger. Accounting is a process of recording financial transactions of business. The objective of trader is to get the useful information relating to business from the recorded entries. For example, detailed total purchase during the years, sales, types and amount of expense, types of amount of income, total assets, total receivables, liabilities, payables, profit earned and loss suffered, etc. These types of various information can be known or obtained from a journal or subsidiary books. Means to deal with these transactions, we prepare a specific account that is called ledger accounts. Okay, so on this basis, ledger account, we are putting some entries on debit side as well as credit side. And finally, this ledger balance provides a closing balance on which the next step to prepare a trial balance. Okay, and trial balance is the next part. So this is the ledger, and I am sharing a ledger account specimen. Here it is date, particular, JF amount, again date, particular, JF amount. So from date to amount, this much, it is called debit side, and from date to amount, this is called credit side. Okay, this is called debit, this is called credit side. For every journal entry, there is specific account that we have to prepare. So total number of accounts what we have to prepare, it is depends on journal entry. Now here date on which the transactions occurred, particulars, we have to write the name of opposite party, JF, full form of JF called journal folio number. In journal entry there is a specific column called LF, ledger folio number. Here it is a journal folio number. There is no need to write anything in this column, but for exam purpose we have to prepare a JF. It remains blank in this chapter, but for practical reasons I will give you the examples for what reason we are preparing journal folio number. In JF column we have to record the invoice number called is it's called a bill number for such transaction. If I purchase the goods from some other party, then date that we mention, name of party that we mention, amount that we also mention here, but bill number that we have to record in JF column. Practically, theoretically, in JF column there is no any other value, it remains blank ever. Again date, particular, JF and amount. Okay, so these are the basic explanations for date, particular, JF and amount. Then after, what is account? Account means summary showing debit and credit balance. Transactions affected during this specific period related to either individual goods, assets, income, expense, prepared in specific format according to the rules of accounting. means this account that we prepared according to the rules of accounting. It is related to any person, any expense, any incomes, profit, loss, assets, liabilities, etc. Means all kind of items that is related to economic transactions which are covered here. Okay. Then after posting from journal or subsidiary books, a process of recording as per the rules of accounting, either on debit side or on credit side of an affected account. It is known as posting. Means this is this account we call a blank account in which there is no entry. It is called a ledger account. But on this ledger account, we have to record some transactions either on debit side or credit side. Based on journal entries, subsidiary books, and cash book, we are recording such transaction either on debit side or on credit side. It is called posting. Okay, very clear. Here, there is an example. First of all, I am explaining the ledger posting on the basis of journal entry, and journal entry means only single journal entry. Okay, in single journal entry, suppose and there is an example, on this date received 6500 from Raj. So what is the journal entry? We received cash from the Raj. So cash account debit means cash comes into the business. So cash account debit as per the real account. And as per personal account, Raj is a person. So we applying the rules of personal account, and as per personal account, credit the giver, and therefore Raj account credit and total amount 6500. So this is the single journal entry. Now, on the basis of this journal entry, we have to prepare two ledger accounts, because in this journal entry, two accounts are affected. First of all, it is cash and another is Raj. So we have to prepare cash account as well as Raj account. So this is called ledger account. First cash, second Raj. Format is same, date, particular GF amount, date, particular GF amount, debit as well as credit. Now, to record or to posting the ledger into these accounts, we have prepared two accounts. To posting these accounts, the rule is, first of all you have to write date, then after amount, then after name of opposite party. First of all you have to record date, amount, name of opposite party. Okay, here cash account debit, date 15th April, amount 6500, name of opposite party is Raj. So in cash account debit side, we have to write first of all date 2015 April 15, then after amount, against cash amount 6500, then after name of opposite party, means if I am writing in cash account, name of opposite party becomes Raj account, so it is to Raj account. Once again, date, amount, name of opposite party. Why we have record in debit side? Because cash account debit, so we have to record on debit side. Now Raj account credit by again same amount 6500. So here Raj account credited, because here Raj account is credit. So Raj account credited by 6500, date, amount, and name of opposite party. If we are writing the if we are posting the amounts in Raj, then opposite party becomes cash. So in Raj account, we have to write by cash account. Means in every journal entries, two ledger accounts are affected and two different postings in different account. In cash account, it is on debit side. In Raj account, it is on credit side. But if we are writing amount in cash, name of opposite party Raj. If we are writing amount in Raj, name of opposite party that is cash. So this is called ledger posting. But this is the example of single journal. But now I'm going to explain for combined journal. So in next example related to combined journal, yes, on 10th August 2015, goods of 18,000 purchased from Vishal and paid 6,000 in cash. In this transaction, first of all we purchase the goods, purchase account debit for 18,000. We paid 6,000 in cash, cash account credit 6,000. Now, out of 18,000, we paid 6,000 only. So 12,000, it creates a specific relation called creditor. So for difference amount, name of creditor, Vishal account credit for 12,000. So here, journal entry, purchase account debit 18,000, Vishal account credit 12,000, cash account credit 6,000. So now, here we have to prepare purchase account, Vishal account and cash account. Format is same, date particular JF amount, date particular JF amount. Now, here you can see that in combined journal entry, in debit side there is only single ledger. But in credit side there are two different entries, Vishal as well as creditor. So it is called combined entry. Here Vishal account credited by 12,000. So first of all, I am going to record the on credit side. Vishal account credited by 12,000. So in Vishal account credited by 12,000. Date 10. Amount 12,000. Name of opposite party against Vishal. The name of opposite account that is purchase. So we have to record by purchase account. Then after cash account is also credit. So in cash account, credit side 6,000. In cash account, credit side 6,000. Date is same, amount 6,000. And against cash, name of opposite account that is against purchase account. So against cash account, purchase account that we have to write. So Vishal account credited by 12,000. Cash account credited by 6,000, and now on debit side total amount is 18,000, but we can't write 18,000 in single amount because against 18,000 there are two different ledger are affected. Two different ledgers are affected. So that's why we have to record the amount 18,000 but not by single way. Here 12,000 and 6,000, both amount that we have to debited into this account. 12,000 and 6,000 total amount affected by 18,000 only. But here two different ledger accounts, so two different name, two different amount, but total remains same 18,000. So now against 18,000 we have to write 12,000 as well as 6,000 For 12,000, name of person Vishal, and second one cash. So to Vishal account, to cash account, date same, amount as per the relevant ledger, and name of ledger Vishal as well as cash. Okay, so this is called combine entry. Compare as per comparison to the single journal entry. In combined journal entry, it requires more concentration to cross the entries. And now here you can see that in debit side there is single account, in credit side two ledger accounts are affected. In another way, it may happen that in some another example, two different entries in debit side and only single entries in credit side. It is also called combined entry, but overall rules remains the same. So not to worry about it. Okay.